if you look at the trueflation, which is this on-chain inflation metric, they're showing inflation in the US is currently 4.1%. My forward-looking indicators based on all of the work on the business cycle, and it's not really voodoo, it's pretty straightforward, that stuff is showing we get to 2% or even below by the summer. My work suggests we've got a decent chance that inflation goes negative.
Pal, the CEO and co-founder of Real Vision Group, recently shared some intriguing insights about the relationship between Bitcoin and the traditional banking system. According to Pal, Bitcoin's price has surged by 40% since the onset of the banking crisis as investors seek out alternative options to the fragile banking system. He believes that this trend is likely to continue as more investors become aware of the vulnerabilities of traditional banking. Pal also highlighted the correlation between Bitcoin's price movements and the Federal Reserve's balance sheet. Whenever the Fed increases quantitative easing, Bitcoin's price tends to rise while it decreases during periods of quantitative tightening. This information provides valuable insights for investors looking to diversify their portfolios and navigate the complex world of cryptocurrency and traditional finance. Prior to moving towards the video, make sure you subscribe to our channel and hit the bell icon so you never miss any upload of ours.
The issue is the yield curve got massively negative. In fact, the second most negative yield curve since 1980. So that means that the banks ordinarily would have to pay you 5% or 4% interest on your deposit, but then they invest it in the bond market in 20-year bonds or 10-year bonds or 30-year bonds, and they're actually getting less money. So they're losing money every day. So what they did is artificially change the yield curve. So they said, well, we're actually going to give you 0.5% interest on your money, and then we can lend it out in the bond market at something different, at a higher rate. So they've manufactured a steeper yield curve. The issue is people have the freedom to move their deposits. So they can move their deposits out of this 0.5% world into a 5% world of CDs, Treasury Direct, money market funds. So people are incentivized to move their deposits because the rate of interest is actually the highest we've seen for a long time. So people are incentivized to do that. That means deposits shrink from the system. As they shrink, you have to unwind the bets that you had at the long end, the longer maturity bets. Now, the problem is those are all underwater because the Fed raised rates so much. So then they've got losses, mark-to-market losses. But to collapse the deposit base, you have to realize those losses. Normally, you can just leave them on your book as mark-to-market accounting. You don't need to worry about it. But in this case, you have to do something about it. Suddenly, poof, they're all got no money. So that's the real issue here. Now, there is a big shit fight going on about what people should do about it, what the government should do about it, what the Federal Reserve should do about it. People say, well, if people are getting scared now because they saw Silicon Valley Bank and Signature Bank go under, well, we should just guarantee deposits in the system. Okay, sounds great. Problem is, it doesn't get rid of the actual issue. The actual issue is the rates are too damn high. So the banks can't make any money. So if they just guaranteed the deposits, people still go to Treasury Direct and get their 4.5% or 5% yields. So it doesn't stop it, slows it down somewhat.
He believes that the market could experience explosive growth similar to what was seen in 2013. Pal thinks that the market is primed for strength, particularly given the correction that occurred in 2019 due to the G5 central bank's balance sheets contracting over that period. However, Pal also expects there will be significant pushback from governments as more people move into the Bitcoin market. Despite this, he suggests that if the United States fails to recognize the growing interest in cryptocurrency, many crypto companies could move to the United Kingdom. Pal's insights provide valuable food for thought for anyone looking to invest in this exciting and rapidly evolving industry.
I got into Bitcoin. So assets will go up according to the balance sheet. I think the balance sheet goes up significantly, 30% plus over time. Therefore, the equity market can go up 60% in the S&P, maybe more. So new all-time highs in the next 12 months or so, maybe a bit longer. NASDAQ gets there sooner because of its relationship. Crypto moves very fast. I got into Bitcoin in 2013 because I lived the European banking crisis and obviously the financial crisis. But the European banking crisis was very similar to what's happening now. the local bank in the village that I went in went under and took everybody's deposits. They bailed them in. We had a run on deposits, liquidity issues. They were invested in things that were illiquid, which was real estate. Real estate market had come under pressure. Very, very similar. Too many small banks in Europe.
Pal's interest in Bitcoin was sparked by the financial collapse of Lehman Brothers and his realization that there was a lack of trust in the traditional banking system. Although Bitcoin's volatility made some people skeptical about its ability to act as a wealth preservation asset, Pal believes that holding it over a longer time horizon can yield exceptional results. In fact, he claims that Bitcoin outperforms the Federal Reserve's balance sheet and any other asset in existence if held for a long enough period. Pal's insights suggest that Bitcoin's potential as a long-term investment is worth considering for those looking to diversify their portfolios.
And I realized that there was no trust in the financial system, i.e., nobody knew who owned what when Lehman went under. And they were terrified of others going under because of the same issue, because the daisy chains of collateral are everywhere in this market. And then when you realize in a bank, you don't actually own your money. And people are now realizing that. And the treasurer and the Fed are like, well, we'll just pretend that's okay. That drives people into this parallel financial system. I got into Bitcoin in 2013 for exactly this reason and have been an active participant of the market ever since. And so I think what Balaji is saying is, listen, guys, here's the life raft. You can take it. Now, Bitcoin's relationship with the Fed balance sheet is really interesting because it goes up exponentially. So if I look at it versus M2 year on year or the Fed balance sheet year on year, it massively outperforms in the bull markets and then pulls back when the liquidity comes out of the system again, but it keeps going up. So yes, I think there is a potential setup here for Bitcoin and the whole crypto market actually to be shockingly strong, more like 2013 than 2019. 2019, we had that big correction, and that was partly due to this G5 central bank balance sheets. Some of them were contracting over that period of time, and it pulled back the crypto market. This time around, I don't think we're going to see that. I think we're going to see all of the central banks falling into place because there's banking issues both in Europe and the US, and China has its own issues. So that they've all got the same issue, which is debt. They're all going to have to stimulate. So I think it's more likely to play out like 2013, which is very squeezy, then sideways consolidation, then very squeezy. Because, every time we go through these cycles, more and more people understand what the benefit is of Bitcoin. And now we've got 300 million people that have used Bitcoin and other crypto. The next time around, it'll be 1 billion people or 600 million people or whatever the number is. And those people will have been awoken to the fact that there is another way out of this. Now, the issue is, as we all know, is Bitcoin is extremely volatile. So it's very hard to think of it in terms of, well, it's a wealth preservation asset because people's time horizon is too short. But if you hold it long enough, it does extremely well. It does better than the Fed balance sheet, better than any other asset in existence.
Pal believes that continued appreciation of the dollar could be disastrous for these assets. He pointed out that the dollar index has already experienced a significant parabolic rise, indicating that it could potentially reach levels of 120. If this were to happen, Pal warns that it could destabilize everything. His insights suggest that investors need to keep a close eye on the dollar's movements to protect their portfolios from potential market disruption. Pal believes that the U.S. dominance could eventually lead to the collapse of the dollar as a global reserve currency. While it may be difficult to achieve with such high levels of debt, Pal sees the gradual erosion of the dollar's strength as a real possibility. In fact, he argues that the more the dollar strengthens, the more it will choke and force people to seek out alternatives such as cryptocurrencies. Pal's insights highlight the need for investors to consider the potential risks associated with the dollar's dominance and to explore alternative assets to diversify their portfolios.
87% of all world trade is in US dollars, and a vast majority of global debt is in US dollars. The US economy itself is the largest indebted economy as a percentage of global GDP in world history, but then everybody else has dollar debt. So the world is something like 400% of GDP in debt, of which at least 50% of it, maybe more, maybe 70% of it is US dollar debt. So you need dollars or everybody goes bust. That's why the dollar keeps going up. People just don't understand is that everybody has dollar debts and all trade is in dollars. So you need dollars. And the less money there is in the system, the more desperate you are in that game of musical chairs to get those bloody dollars to pay your debt or you go bust. That mechanism is not going to change. In fact, it may get much worse. Over time, we're seeing the Chinese, the Russians, others trying to move away from this. But it's really hard because if your debts are in dollars, if you're South Korea, you don't want bloody yuan. You want dollars. You need dollars for your entire banking system. So I don't see a route by which that changes. And the US is also a geopolitical force, the largest geopolitical force, and they will force people to use dollars by coercion. So can that fall apart? It can if you debase your currency enough, which is kind of, it's not hyperinflation, but it's a different route to it, and it can lead to the same thing. Bloody difficult to do with this much debt around, unless they suddenly printed $50 trillion. So I think it happens over time. And it happens because the dollar is too strong, not because it's too weak. And the stronger the dollar gets, the more it chokes and forces people to find alternatives. Whether that's cryptocurrency for a lot of people, I think Bitcoin will work for a lot of people over time once the volatility of it comes down as the adoption keeps rising. And others will form regional trade groups and will have maybe global currencies. There's no reason we can't start creating global currency baskets as on chain as a stable coin. It doesn't have to be a US dollar stable coin.
In conclusion, Raoul Pal's insights shed light on the potential impact of the US dollar's strength as a geopolitical tool and its potential to choke the global economy. The question remains, will the US continue to use the dollar as a means of coercion, or will we see a shift towards alternative currencies and assets as global power dynamics continue to evolve? Let us know in the comment section below. If you find our content helpful, then give this video a thumbs up and make sure to subscribe to our channel. We look forward to bringing you more updates in the future.